It used to be a mundane ritual. You'd walk to the mailbox, sift through the junk mail, find that envelope from your home insurance provider, and barely give it a second thought. Maybe the premium went up $50, maybe $100. You'd grumble, write the check, and move on with your life. But recently, that ritual has changed. For millions of Americans, opening that renewal letter feels less like a chore and more like a shock to the system. I'm talking about premiums doubling overnight, deductibles skyrocketing, or in the most unsettling cases, a letter stating that your coverage is simply being non-renewed. You aren't imagining it, and you certainly aren't alone. We are currently living through the hardest market for property insurance that we have seen in a generation. If you are sitting at your kitchen table right now, looking at a bill that costs more than your mortgage payment did 20 years ago, you are asking the same question everyone else is. Why? Why is this happening now? And more importantly, is there anything we can actually do about it? Today, I want to bypass the sensational headlines. We aren't here to panic. We are here to understand the mechanics of this market shift. We need to look at the global macroeconomic gears turning behind the scenes, from global reinsurance markets to the cost of lumber, so that you can make decisions not out of fear, but out of clarity. To understand why your bill is soaring, we first have to look at the fundamental equation of insurance. It's supposed to be simple. The premiums of the many pay for the losses of the few. But that equation has been unbalanced by a perfect storm of economic factors. Let's start with the one that hits your wallet directly: inflation. But not just the inflation you see at the grocery store. I'm talking about construction cost inflation. According to data from the Producer Price Index, the cost of construction materials and services surged over 30% between 2020 and 2024. Think about it this way. If a storm damages your roof, the insurance company isn't just cutting you a check for what the roof cost in 2015. They have to pay a contractor to fix it in today's dollars. They have to buy asphalt shingles at today's prices. They have to pay labor at today's wage rates. If the cost to rebuild your home has gone up by 40%, the cost to insure that home has to follow suit. It's simple arithmetic, but it feels personal when it hits your bank account. But here is where the numbers get strange, and this is the part that most people don't see. It's not just about the cost of wood and nails, it's about the cost of insurance for the insurance companies. This is a concept called reinsurance. You see, insurance companies don't hold all the risk themselves. They buy their own insurance policies from massive global entities, often based in places like Switzerland or Bermuda, to protect themselves against catastrophic events. If a massive hurricane hits Florida or a wildfire sweeps through California, the local insurance company relies on this reinsurance to pay the claims. In the last 2 years, reinsurance rates have spiked dramatically. Why? Because the global models for risk are changing. We are seeing what actuary scientists call secondary perils. We all know about the big hurricanes, but we are seeing a massive increase in losses from severe convective storms, hailstorms in the Midwest, tornadoes in the South, wind events in the Northeast. These aren't headline-grabbing disasters, but they cause billions in damages. Because the global reinsurers are charging more, your local carrier has to pass that cost down to you. It's a global macroeconomic shift landing right on your front porch. Now, does that mean the system is broken? Not necessarily, but it is undergoing a severe correction. For decades, home insurance was arguably underpriced. Companies were competing for market share, keeping rates artificially low. What we're seeing now is the rubber meeting the road. The market is trying to find the true price of risk. Unfortunately, that correction is happening all at once, and it's happening at a time when household budgets are already stretched thin for the cost of living. And there is another layer to this onion: technology. 10 years ago, an insurance inspector might drive by your house once a decade. Today, insurers are using aerial drone imagery, satellite data, and AI-driven models to scan your property. They can see if your roof has moss on it. They can see if you have a trampoline in the backyard. They can see if tree limbs are overhanging your garage. They are de-risking their portfolios with surgical precision. This is why you might hear stories of people being dropped for seemingly minor issues. The algorithm has tightened, and the margin for error has disappeared. So that is the heavy reality. The costs of rebuilding are up, The cost of capital is up, and the scrutiny on your property is higher than ever. It feels daunting, but feeling helpless is not a strategy. To navigate this, we need to shift our mindset. We need to stop looking at insurance as a bill to be paid and start looking at it as a risk management tool that needs to be actively managed. Let's talk about the first and perhaps most effective lever you can pull: the deductible. For years, the standard advice was to have a $500 or $1,000 deductible. In the financial environment of the 1990s, that made sense. Today, though, it's a luxury many cannot afford. We have to ask ourselves, what is insurance actually for? Is it for a broken window, or is it for a catastrophic loss that would wipe out our net worth? By raising your deductible from $1,000 to $2,500 or even $5,000, you're essentially telling the insurance company, I will take care of the small stuff, you handled the disaster. In exchange for taking on that small slice of risk, premiums often drop significantly. Of course, this requires you to have that emergency fund in place. This is where kitchen table economics comes in. If raising your deductible saves you $600 a year, take that $600 and put it into a high-yield savings account. In a few years, you have self-funded your own deductible, and you're pocketing the savings moving forward. But let's look deeper, because simply raising the deductible isn't the only move on the chessboard. We have to talk about replacement cost versus market value. This is a common point of confusion. You might say, my house is only worth $300,000 on the market. Why am I insuring it for $400,000?
Remember, insurance covers the cost to reconstruct the home, not what you could sell it for. However, you need to review these numbers annually. If you have an inflation guard on your policy, your coverage limit might have crept up automatically every year. Sometimes it creeps up too high. It is worth sitting down with an agent and asking for a detailed replacement cost estimator. Ensure you aren't paying to rebuild a palace if you live in a ranch. You want to be fully covered, yes, but you don't want to be overinsured for a square footage that doesn't exist. Another critical factor is your credit score. Now, this depends on where you live. Some states, like California and Massachusetts, restrict the use of credit in insurance pricing. But in most states, your insurance score is heavily weighted by your credit history. The data shows a correlation between credit stability and the likelihood of filing claims. It might seem unfair, but it is the reality of the algorithm. Maintaining a strong credit profile is, surprisingly, a home insurance defense strategy. And then there is the physical hardening of the home. In the industry, we call this mitigation. Insurance companies love it when you reduce their risk. In many states, specifically those prone to wind events, getting a wind mitigation inspection can open the door to mandatory credits. We aren't just talking about a new roof, we are talking about the shape of the roof. Hip roofs often get better rates than gable roofs. We're talking about how the roof is attached to the walls, clips versus toenails. We are talking about impact-resistant windows. I know replacing windows is expensive, but this is a long-term play. If you are planning a renovation, choose materials that the insurance industry favors. Upgrading your electrical system from old fuses to modern breakers, that's not just safety, that is insurability. Removing that old diving board, that's risk reduction. But here's a warning, and it's something we need to discuss because it's becoming a trap for many retirees. The state-backed plan of last resort. You may have heard of FAIR plans or Citizens in Florida. These are government-created insurance pools designed for people who cannot get coverage in the private market. When you get that non-renewal letter, panic sets in, and this feels like the only lifeboat. And sometimes it is, but be very careful. These policies are often more expensive and offer less coverage. They're a bandage, not a cure. If you find yourself forced onto a state plan, make it your mission to shop the private market again every 6 months. The market appetite changes. Just because you are a no today doesn't mean you're a no next year. Let's zoom out for a moment. What we are witnessing is a fundamental shift in the cost of homeownership. For the 40-plus demographic, this is particularly jarring because our homes are often our largest asset and our sanctuary. We worked decades to pay them off, only to find the rent on owning them, the taxes and insurance, is climbing. It's easy to feel like the victim of a faceless corporate machine, but I want you to feel empowered. You are the CEO of your household. You have the ability to negotiate. Here's your action plan. First, shop the market. Loyalty adds no value here. If you have been with the same company for 10 years, you are likely paying a loyalty tax. New customers often get better rates. Call an independent broker, someone who represents multiple carriers, not just one brand. Let them do the legwork. Second, bundle intelligently. Yes, combining auto and home usually saves money, but do the math separately first. Sometimes the savings on the bundle mask the fact that the home policy is overpriced. Third, review your exclusions. As costs rise, some insurers are quietly adding specific deductibles for wind or hail, or removing coverage for water backup. Don't trade a lower premium for a policy that has holes in it. A cheap policy is the most expensive thing you can buy if it doesn't pay out when you need it. We're in a cycle. Economic history tells us that insurance markets are cyclical. They harden, prices go up, capital floods in to chase the profits, competition returns, and prices eventually stabilize. We're in the painful part of the cycle right now, but it won't move in a straight line forever. Until then, stay vigilant, read the fine print, ask the hard questions. And remember, protecting your home isn't just about paying a premium. It's about understanding the changing world around us and adapting our strategy to match it. You've navigated economic shifts before. You've seen interest rates at 18% in the 80s. You've seen the dot-com bubble and the Great Recession. This is simply the next challenge on the board. And like those before, with the right information and a cool head, it is a challenge you can manage. This content is for educational purposes only and reflects general market trends, not individual insurance advice.